This is InvestTalk. Independent thinking, shared success.
I was calling you guys about ticker symbol CLH, which is Clean Harbors, and I've held this for a while. It's done pretty good. Should I trim this? Curious to know your analysis. We really appreciate the show and hope you guys have a great day. Thank you.
All right, looking at Clean Harbors, and this is in the business, in the business of cleaning up environmental waste. It collects transportation, treatment, disposal of site decontamination of hazardous material. So certainly a very good, consistent business. It has pulled back recently, I will say that, but it's still in a broader uptrend. Right, it's fallen from 260 all the way to 193. We pull back to a monthly chart here. The monthly was overbought, and it needed this. It needed this pullback. Let's just say that. It was a little bit too expensive. It's now down to the 100-week moving average, and that is major support. But I do worry about the trends in earnings, which are expected to be a bit lower this year and next year from where they previously were. And it's trading at a mid-20 multiple, which is on the expensive side. Now, they have a good balance sheet, but it's a very profitable business, 16% return on equity, free cash flow about $300 million on a $12 billion enterprise value. That's a little steep from a free cash flow perspective, right? Trading at 2% free cash flow yield, that's pretty low. So I would say I would be trimming this on a rally. Now it's oversold now after this drop. Let me give you a number that we can get this back into. Yeah, I think this gets back into 215, 220 in that range. That's where I'd be trimming Clean Harbors. It's definitely overbought on the monthly chart and you're not going to get the same returns most likely over the next couple of years as you have over the past few years. So definitely still a great company, great balance sheet, just a name I would be trimming on a bounce.
Thanks for being here.
If you found this video valuable, please like it and subscribe to our channel for more insights.
Hey guys, love the show. This is Eric from Utah. Just got a quick question. I like the aerospace and uranium industries a little bit, and I'm looking at ticker symbol BWXT. I had a recent pullback and just wanted to know your thoughts. I do have a position in it now, looking at buying more. Look forward to hearing your answer.
All right, looking at BWXT. This is a name that we do own for clients. We've owned it for some time. I believe we bought it in the 60s, I want to say. And it had a recent run up all the way up to 134 and change, and it's pulled back to around $100. In fact, today it closed right at $100. So it is into some good support. I will say that we like the company mainly because what they do is they manufacture power generation systems and nuclear components for the U.S. government, industrial, and utility space. And we think that the demand for nuclear power is going to continue to grow for many reasons. From obviously climate reasons, you also have base power needs for data centers. You have cryptocurrency, energy demands, just growth globally, etc. So we think that these type of companies will continue to do well. Now, $9 billion market cap, so it's a mid cap. I would say we think it's fairly valued around these levels. So we think it's a good buy, not a steal, but a good buy and at good support. So we like BWX Technologies. And if you look at its profitability, let me pull it up here. Yeah, return on equity, 28%. They have very minimal debt on their balance sheet. So good balance sheet there. $250 million in free cash flow on a $9 billion market cap. So about a 3% free cash flow yield. Not a steal once again, but about fairly valued with its growth and the demand in the industry. And they're taking that cash flow and they are paying out it's a little dividend, about 1% dividend yield. But we think that has plenty of room to grow with a payout ratio of only 31%. and they've been raising that dividend. So we think that will continue to go up over time. So we like BWXT, and it's had a nice pullback as of late. Now let's make it 2 in a row from our voice bank number at 888-99 chart.
Hi guys, love the show. A quick question about Backdoor Roth IRAs. Could you explain what they are, how much you can contribute, and if there's a benefit to this process? Thanks. Bye.
So a backdoor IRA, Roth IRA contribution is pretty simple. You make a non-deductible IRA contribution and you immediately convert it into a Roth. Now, there's some rules around this. You can't have any IRA money that's out there in accounts. So you have to clear out your IRAs. And that can be a challenge from a tax perspective if you don't want to do that. But yeah, it's just a loophole to get around the Roth contribution income limit. So if you make too much money, you can't just make a normal Roth contribution. So instead, once again, you're putting it into an IRA, non-deductible, and then you're converting it immediately. So it's effectively a Roth contribution. It just takes a couple extra steps. So I do that personally, and I think that's a good plan for somebody that doesn't have any money in an IRA, or maybe a small amount that they're willing to convert. Now, we've been telling your friends that our audio podcast is available in video form over on our YouTube channel, and we get questions submitted over there as well. So let's gather one of those now and answer it. Gilliby24 says, thank you for the excellent insights you constantly provide. With MEDP experiencing a recent decline, would you consider this an opportune time to increase holdings, or might we expect additional downside before adding more? All right, taking a look at MedPace, MEDP is the symbol, and this is has come down recently, peaked out around $450 per share. Now it's around 326, kind of chopping around the 100-week moving average. And I think that's one of my issues here, is that it tested that level back in November and had a bit of a bounce, but it's rolling back over. So to me, the more a certain moving average is hit, the less support it is. And I think this is going to break through. Now, for everyone else out there, what does MedPace do? What does MedPace do? Well, it's about a $10 billion market cap, and it provides outsourced clinical development services to the biotech, pharmaceutical, and medical device industries. So it's running these clinical trials. Here's the problem. Revenue is slowing. It was going up in the mid 20% range late in 2023. Last quarter, only 8%. And earnings this year are expected to drop 2%. And those estimates for this year and next year continue to go lower. And it's still trading at a mid-20s multiple for something who has flat to negative earnings growth expectations. That is a recipe for a further decline. More multiple compression. And then you add on top of that the broader backdrop of what's happening now. First off, higher interest rates. Higher interest rates are the death knell of biotech. You saw that in 2022. And if you go to the biotech sector, they have not really recovered. IBB, for example, peaked out. IBB is a biotech ETF, iShares. Peaked out around 175, hit a low of about 104, but it's only bounced to 133 today. And it's rolling over again. It has bearish pattern. So if the biotech space is struggling, well, MedPace is probably going to get less sales. And then you add RFK, right, who's coming in and shaking up the industry to a degree. And you can discuss whether that's a good thing or a bad thing. I'm not arguing one way or another. But what I will say is it's probably not going to be helpful he's not going to be helpful. His administration is not going to be helpful to a lot of what happens in the biotech space. I read a report recently that only 7% of internally produced studies in the pharma industry can actually be replicated. So that's a challenge, and I'll probably push on that, and the process is there, which will make it harder for the biotech space as well as MedPace. So I think there's far more downside for MedPace. I actually think it's a pretty good short. I wouldn't touch it probably at least until the end of this administration, until you get some settlement within the space around HHS, et cetera. So I'd absolutely pass on MedPace. Okay. Now let's talk about equities, long-term returns. And this is a great study. It's by a Santa Clara University professor and looked at data for equities going all the way back to 1792. Okay. And a lot of people think that, hey, buy the dip. But we've been in this buy the dip era since 08 or 09, right? But as they say, past performance is not a guarantee of future performance. And when you look even further back, you see that there are periods, decades even, where equity returns can be negative. Now, the most recent example of that is from the 10 years prior to February 2009. That was the bottom, right, in equities after the financial crisis. And you go back 10 years, you're talking about February 1999. Now, that wasn't the peak of the dot-com bubble, but it was pretty bubbly at that time. And it got obviously even higher, so returns are even worse if you're talking about 9.5 years prior to that date. Now, over that 10-year period, equities lost 37.4% in real terms. So this is adjusted for inflation. And there are other periods where equities lost money to inflation over a 10-year period. You're talking September 1974. There was a huge bear market in 73, 74. August of 39. So obviously go back to August 39, 1929. June of 1921. So there was a mini financial crisis back then in 1921. October 57. Sorry, not 1957, 1857. You're talking Civil War era. And then April 1842. Those are the periods where the previous 10 years, equities lost money in real terms. And there were actually periods where over 20 years, equities lost money. Talking about June 1932. That was a 13.9% loss in total in real terms, the previous 20 years. And then October 1857, that was about an 8.8% loss. And June 1921, that was a 4.7% real loss over the previous 20 years. And that can happen in international markets as well. It's not just domestic. I mean, places like Italian stocks, the 20 years prior to 1979 lost 78.2% in real terms. Japanese stocks, so you're not talking about wartime or pre-World War II. This is ending in 2009. The 20 years prior to that, Japanese stocks lost 64.3% because there was a massive bubble there. So what is this telling you? It's telling you that price matters. Price matters. Now, they're looking at the broad indices. So just because the broad indices were negative doesn't mean that all stocks were negative and there weren't other opportunities. There were. Right? Plenty of companies did well from, say, 1999 until 2009. But you can go through challenging periods, and it's usually when equity values are rich. So what I'm saying here is, likely going forward, you aren't going to get the same level of equity returns from the broad indices. Underneath the surface, there's plenty of great opportunities, plenty of great values. But this study tells you that you can't just bank on buying the dip, buying the big names, the ones you know the most, and you're going to do great. It's not guaranteed. Doesn't mean it can't work out. Just understand that the last 10, 15 years is more the anomaly, not the rule. Now let's keep moving and play another listener question from 888-99-chart.
Hi, Justin. I was hoping you could take a look at Roche Holding for me today, ticker ROG.SW. There is limited information on the stock because it is a Swiss company. But if you could take a look at the fundamentals and maybe take a look at the chart long term for me, it would be much appreciated. I actually have some stock options that I need to figure out what to do with, and any guidance would be appreciated. Thank you. Love what you do. Bye.
All right, looking at Roche Holdings. Let me see what I have here. These foreign stocks are always, I always have to bring them up on different systems, and those systems are a little bit slower. So bear with me here. So this has been relatively flat since 2020, call it start of the pandemic. It hasn't done great. Now it's starting to do well recently. And this goes back to what I've been saying is foreign stocks are suddenly doing well. We're definitely looking at a lot of foreign companies more than domestic names right now. This is a Swiss biopharma and diagnostics company and has good oncology drugs that acquired from Genentech back in the day. And yeah, I mean, it's certainly a good business, $302 billion market cap. Let me take a look at the balance sheet here. Yeah, not a lot of debt, free cash flow, about 17 billion. That gives it about almost a 6% free cash flow yield. Solid dividend. And I think it continued to pay that dividend because of that balance sheet and that cash flow. The chart is looking better. I would continue to hold it. Now, this is more of a broader, just looking at this name, but bigger picture, what is your weighting to this company? Talk about stock options. Maybe you still work for the company. I would worry about maybe having too much exposure. So think about that. But overall, I like what I see here. Valuation, trends in stock price, fact that it's a foreign name, probably under-owned. It's plenty of cash flow to pay that dividend, and it's taking some of that cash flow and buying back stock. So I'm going to give Roche a thumbs up.
Don't miss out on critical market updates. Subscribe to the KPP Premium newsletter for weekly insights delivered straight to your inbox.
Now let's drop in a fresh question from the comment section over on our YouTube channel. Ryan Ketza says, hi guys, wondering what you think of KNSL Capital Group fundamentals look pretty good. I know you like insurers. They do specialty insurance. So I was wondering if KNSL might be a good investment or if the niche of excess surplus insurance is inherently risky. Well, all insurance is risky to some degree, but specialty insurance typically is pretty profitable because it's not commoditized and it takes special expertise, etc. So this is a name that has been growing consistently. I like its growth. Right? Earnings were in 2018, $1.79. This year, so it's earned $17.37. It's a tenfold increase in 7 years. That is quite impressive. Small dividend, but good growth, is trading at a high multiple for an insurance company, but the growth is warranted. Now, what I would do a little more research, and obviously I haven't looked at this, I can't look at it so quickly, but what's driving that growth, and is there a cap? Because once the growth does decline, its multiple is going to contract. So how much runway is there on this growth? It's been compounding its growth 10x over 7 years. That is very impressive. Is it likely to do that again? Probably not. But if it does, a quarter of that over the next 7 years, it's still going to do very well. But what is that? What is the source of that growth? That's what I'd be looking at. Now, the technicals are fine. It's in an uptrend. It's kind of been consolidating since the beginning of last year. So the recent performance has not been amazing. But what about this company makes it so special with that level of growth? That's what I would be asking. and whether they can start to hit a continued level of, mid-teens growth. If they can do that, then I think it's worth it. If it decelerates into the single digits in growth rate over time, I think that's a challenge and multiples will come down. Now, lastly, let's talk about this pullback in markets. Now, if you look at the driver of this pullback, it's mainly been the big tech names. And I've said this multiple times, but it's so important because if you look at the returns of the 50 worst performing stocks since February 19th, they have a total negative return of 22% on average total return, negative 22%. If you take those same 50 stocks and you look at their performance from October of 2023, the last real major market bottom, up until last month, they return on average 104% over that period. So they've given back a quarter of those returns pretty much since. If you look at the 50 best performing stocks over the past month, they're on average up 11%. And not a surprise, their returns since the last rally were not nearly as strong. So really what this is it's profit taking. And a lot of it has to do, I've said this before, it's market structure. It's the speculation around option activity and dealer hedging, and that came unwound in a big way. Now, can that continue to come unwound? Absolutely. Can this correction in the big tech names, those top 50, shall we say, growthier names, could that continue? Absolutely. But in order for a bear market to commence, you're going to need the sell-off to widen out. And it's not really doing that. Like I said, if I pull up a month chart, you go look at a heat map of the market over the past month, it looks very interesting. Because there's a ton of red in NVIDIA, Apple, Microsoft, Google, Amazon, Meta, Tesla, all down double digits. But a lot in healthcare is up. Consumer staples are up. Many energy names are up. Exxon's up almost 5% over the last month. Berkshire's up 9% over the last month. So this could be a garden variety correction and profit taking in those names that were just too expensive. That can be a result. Now, I'm not calling for that, but you have to be on the lookout for signs that that's all there is, and we'll keep you up to date on that. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes and join our second annual InvestTalk Market Madness competition. It is underway, but today is the last chance to enter because the first matchups start tomorrow. And if you win $1,000. And if you need help understanding your financial situation and whether you are aligned with your risk tolerance level and your broader financial goals, I encourage you to head over to investtalk.com and schedule a call with me. Independent thinking, shared success. This is InvestTalk. Good night.